Welcome to Edgemoor Investment Advisors' video presentation of our fourth quarter 2025 market review and outlook. I am Steve LaRosa, and I am joined today by my colleague, Gay Truscott. Our agenda for today's presentation mirrors the topics discussed in our quarterly newsletter, which can be found on our website, edgemoorinv.com. Here are the topics we will cover today. 2025, the year in review. The U.S. economy still showing resilience. What we are watching in 2026. Portfolio implications and actions. Our outlook, and a review of two selected securities. Let's get started. In 2025, U.S. markets experienced significant volatility at the start of the year, but ended it with most major stock indices near record highs. There was a sharp sell-off in April 2025 following the announcement of new tariffs on nearly all U.S. trading partners, which sent the S&P 500 index down nearly 20%, briefly approaching bear market territory. However, U.S. equities staged a remarkably quick recovery when many of the tariffs were paused just a week later. As seen on this slide, the S&P 500 index was once again reaching record highs by late June, as trade conditions stabilized, corporate earnings remained strong, and artificial intelligence-related investments continued at a rapid pace. For the year, the S&P 500 delivered a total return of 17.9%, representing the third consecutive year of double-digit returns for equity investors. Bond investors also saw positive returns in 2025, with the Bloomberg Aggregate Bond Index returning a strong 7.3% for the year. Several notable events took place in 2025 that impacted markets, both positively and negatively. In January, the Chinese firm DeepSeek made a surprise announcement that it had developed a much cheaper AI model that rivaled the speed and capacity of much more expensive platforms. U.S. tech stocks initially sold off, but subsequently recovered when the validity of DeepSeek's claims came under scrutiny. Then came the Liberation Day announcement on April 2nd of the significant new tariffs on nearly every trading partner of the U.S. Markets were rattled again, but not for long. Another external shock occurred in October, as the U.S. federal government began its longest shutdown in history, lasting for 43 days. Once again, the stock market generally remained unfazed. On the positive side, the Federal Reserve took its finger off the pause button and cut its benchmark Fed funds rate by 0.25% in each of the last three meetings of the year, September, October, and December. These cuts were largely applauded by markets, although they reflected a fundamental reality that the labor market was starting to slow. Overall, the U.S. economy continued to show remarkable resilience in 2025. U.S. GDP grew at a better than expected annual rate of 4.3% in the third quarter of 2025, the fastest pace in 2 years and significantly higher than the 3.3% rate that economists had expected. The growth was driven by robust consumer spending, rebounding exports, slowing imports, and increased government spending prior to the shutdown. For the fourth quarter of 2025, the latest forecast for GDP from the Atlanta Fed's GDP Now model is a slower growth rate of 2.7%, reflecting a slowdown in both personal consumption and private investment. However, their forecasts are subject to revisions. For the full year 2025, GDP growth is expected to range between 1.5% and 2%, which, while positive, would represent a slowdown from the 2.8% growth registered in 2024. Another bright spot in the economy has been corporate earnings, which continued to grow at an impressive clip in 2025. Year-over-year earnings of the S&P 500 index grew by a better than expected 14% in Q3, marking the fourth consecutive quarter of double-digit growth for earnings. For the fourth quarter, earnings are expected to have grown by a solid 8.3%, and for the full year 2025, the figure is projected to be 11% higher than 2024 earnings. Strong earnings growth is expected to continue into 2026 and 2027 as well. Despite the overall positive state of the U.S. economy, headwinds do remain. Over the course of 2025, new job growth declined steadily. Hiring slowed significantly, and wage growth was flat. The U.S. unemployment rate climbed steadily over the course of 2025, starting the year at 4% and ending the year at a 4.4% rate in December. In addition, inflation also remained above the Fed's target rate of 2% during all of 2025. We will be watching the trends in both unemployment and inflation throughout 2026. In addition, a new Fed chair is expected to be announced as soon as January to take over from Chairman Jerome Powell when his term expires in May of 2026. We expect the new chair to be more closely aligned with the administration's view that interest rates should continue to be cut to stimulate the economy. We will also be following the midterm elections, which take place in November, to see whether both houses of Congress stay in Republican control or not. And finally, on a lighter note, we will look forward to America's 250th birthday celebration on July 4th, as well as the FIFA World Cup that starts in June. It should be a fun summer in 2026. Now I will turn it over to Gay to talk about portfolio implications and actions, our outlook, and to review two of our selected equity securities.
Thank you, Steve. I'm going to begin with portfolio implications and actions. After 3 consecutive years of double-digit gains in the stock market, we are somewhat cautious on equities in the near term. However, we have been able to find pockets of opportunity in today's market based on our strategy of individual stock selection, even as the S&P 500 continues to notch new highs. In terms of overall valuation, the S&P 500 is currently trading at about 22 times forward 2026 earnings, which is slightly above its 5-year average. As we have noted before, we believe that some sectors of the market may warrant higher valuations than their historical averages, based on factors like technological progress, productivity advances, and more asset-light business models that have resulted in increasingly higher profit margins and revenue growth for many of these companies. But overall, we continue to favor more value-oriented, dividend-paying stocks that have strong cash flow characteristics, leading market share, a wide economic moat, and solid growth prospects. We also still find short-term treasury bills and other cash equivalents with annualized yields of 3.7 to 4% attractive uses for excess cash. Now to our outlook. While our short-term outlook for the markets is guarded, because we believe volatility may continue until there is more clarity on the labor market, interest rates, and the long-term impact of tariffs and AI on the economy and on corporate profits. Our long-term view of the U.S. economy and markets remains positive. And we continue to emphasize to our clients the importance of sticking to a long-term investment plan focused on specific goals and objectives. We believe that our patient, disciplined approach to individual security selection offers our clients strong long-term return potential in a cost-effective and tax-efficient manner. Now I'd like to talk about 2 stocks which we reviewed in the newsletter and which we are currently buying for client accounts, Alphabet and Lowe's. Alphabet, still better known to many of us as Google, is a global technology company known for its dominant internet search engine, which has roughly a 90% market share of global search revenues. Alphabet's other services and applications include Gmail, YouTube, Google Maps, Google Play, the Android operating system, and Waymo self-driving cars. Alphabet has benefited from several positive secular trends over the past few decades, including the shift of advertising dollars to digital or online platforms, the growth of the cloud, and the steady decline of traditional cable subscribers. Artificial intelligence has also provided a tailwind for Alphabet's growth, as the company has steadily integrated AI features across many of its offerings, including hardware, software, applications, and infrastructure. The company generates strong free cash flow, high returns on invested capital, and enjoys a fortress-like balance sheet. Alphabet's revenues have grown at an annualized rate of 18% over the past 10 years, and the company is expected to deliver annual earnings growth of over 16% in the next 5 years. Alphabet shares trade at a forward price-to-earnings multiple of 29 times, a premium to the market, but one which we think is justified given the company's dominant market share and good growth prospects. In addition, Alphabet stock has consistently outperformed the S&P 500 index over the last 10 years, and we believe the shares still have solid, long-term appreciation potential. Next, I'd like to talk about Lowe's, one of Edgemoor's longest-held stocks. Lowe's is the world's second-largest home improvement retailer, generating $84 billion in annual sales and operating over 1,700 stores throughout the United States. The home improvement market is highly fragmented, and Lowe's size and scale afford it numerous competitive advantages, including an extensive distribution network, economies of scale, and strong brand recognition among consumers and professional contractors. CEO Marvin Ellison has successfully overhauled the company's operations in recent years, upgrading its supply chain, improving inventory controls, and enhancing customer engagement. Lowe's has made particular strides in the high-margin professional contracting market, expanding its fulfillment network and just-in-time delivery options for professional contractors. We believe Lowe's is financially strong and shareholder-friendly, having returned more than $2.5 billion through share repurchases and dividends to shareholders in 2025. Lowe's stock actually underperformed the market in 2025 due to concerns about high interest rates, sticky inflation, and low housing affordability. But we believe that Lowe's is a high-quality stock with solid long-term return potential, given the company's dominant market position, durable earnings and cash flow, and long runway for growth. That concludes our year-end 2025 video presentation. We hope you have found it interesting and informative. We always appreciate your feedback, so please feel free to contact us with any comments. Otherwise, we hope you will tune in again next time. Thank you and Happy New Year.